You need to listen to what they care about and what they want. And then you can start adjusting these 3 inputs. The first input generally people bring up is down payment. The second thing that's brought up is usually interest rate. Everybody talks about mortgages and loans in terms of interest rates. And then lastly, I call it monthly payment, but really it's the amortization.
Welcome to the Collecting Keys Friday Focus.
Hey there, welcome back to another episode of the Collecting Keys Friday Focus. You got me, Dan Austin, as your host today, and I want to talk about getting creative with creative finance. But before I do, I got to do a plug for our Instant Investor program, just because I know there's some people out there that are new listeners or other listeners that have ignored everything Mike and I say and don't actually know we have an awesome group coaching program, the Instant Investor program. And it's exactly what it sounds like. We help teach you and coach you how to be an investor somewhat instantly. You know, we've got people in the program right now that just joined us not too long ago that are going to hit multi-six figures in income this year. We have other folks talking about leaving their W-2 job. So if you're looking to accelerate your growth, look at growing your pipeline of deals, exit your W-2, or just grow your side hustle in real estate, whatever it is, we got something for you here. Go to collectingkeys.com, click on the blue button at the top that says Become an Instant Investor. Book a call and see if you're a good fit for the program. So without further ado, let's dive into some creative finance stuff. And the reason why I'm doing this is because we actually just locked up a seller finance deal last week. And as I was coaching the sales guy through this, we had some other sales guys on our team asking some questions. And of course, in our group coaching, we always have good questions around creative financing. So I thought it was time to bring all this topics to the top of the list and just go down some of the things. And I want to talk about what are the 3 inputs that we generally negotiate, as well as like what are the 3 things that we generally look at to say this constitutes a possible seller finance deal. Now we have other creative finance like subject to novation and stuff like that. Those will be other days. Let's just talk today specifically about seller finance. So what are the things that constitute a possible seller finance deal? Like what are you listening to when you're talking to a seller or you're talking to a lead, whatever it is? What are you listening for to say, this might be a seller finance pitch instead of a cash offer pitch? One of the first things is they want a higher value than we typically offer the cash offer. So say you're offering, 70, 75% ARV minus repairs, but they come in and they're like, I want 85% ARV. You're already knowing right there that, gosh, it's going to be tight for you to flip the property or tight for you to have to do renovations to completely burr the property because you already know you need 75% of the value to get all your cash out. So it's high value. With that being said, it kind of also needs to be somewhat turnkey unless you're okay with investing money or somebody that's okay that you're going to sell to that's okay with investing money into it in addition to a possible down payment. It doesn't have to be turnkey though. Another thing is that they don't want to pay tax. They talk about taxes or you bring up the fact that they're going to pay capital gains and they just really show or speak of some disdain for paying the government, paying the tax man, and they don't want to sell to you because they know they're going to have to pay capital gains. Another thing to listen for is maybe it's a rental property, which is really great, or they do want some residual income. So it's like, it's a rental property for me. I'm an older guy. I don't have any other income. I really enjoy this. It's like my pension, and so maybe they want to keep collecting those rent checks. And for this one, we like to see things that are also rented under market value. So if it's turnkey, they want market value, and they're renting it for $1,850 and the market rent's $1,900. There's not a lot of spread there if they really want that income. So something to think about while you're listening. So our deal that we just locked up is that typical seller finance deal. It's textbook, really. It was a tired landlord. He's 80 years old. He doesn't want to pay taxes, hates taxes. He wanted closer to retail value. He didn't want, 100% retail value, but I think we got in there at probably like 85% retail value, somewhere in there. It does need a little bit of carpet and paint work because it was rented. And like I said, he's a tired landlord. Tenants are moving out and, needs that carpet replaced, some new flooring, some new paint, some new fixtures, those sorts of things just to kind of update it. But it is like a mid-90s built A-class property in a great area. The other thing is he wanted the residual income. He's getting older. He didn't want to have to deal with the tenants and he was renting it quite a bit below market, but he knows what he's got. He's a guy that's been a landlord for a while. He knows he's got a great asset. He knows he can keep getting income from a rental. He knows how to do all that sort of stuff. But he hit those 3 things I just told you. He wanted to avoid paying taxes, or he at least saw the benefit of not having to pay taxes right up front. And he wanted a higher value because he knew he had a good property. And he wants that residual income. So right then and there, we knew, okay, this is a pivot we're going to offer. So then that brings me to my next point, which are what are those three inputs that we're generally negotiating? Before you go out and pitch a seller finance deal and pitch potential terms, you need to listen to what they care about and what they want. And then you can start adjusting these three inputs. The first input generally people bring up is down payment. The second thing that's brought up is usually interest rate. Everybody talks about mortgages and loans in terms of interest rates. And then lastly, I call it monthly payment, but really it's the amortization. But we get to adjust that without it really affecting the first two and also having it reduce the payment. All three of these can reduce the payment amount or increase the payment amount, but amortization is a really powerful tool. So I call that monthly payment just so you can remember it. There's other things that do get negotiated, like a balloon payment. Do they want a balloon payment as the full amortization, so it's a 30-year loan? Or do they want, hey, I want to amortize it for 30 years just because it gets us to that payment amount, and then I want it paid back full in 5 or 7 years? That's typically what we see. So there's that, plus some other stuff that can be negotiated. Again, it's creative, so anything can be negotiated. But let's talk about these three inputs first. So if they want a really, really high down payment, it might kill the deal. Not always. We had a couple that wanted a $100,000 down payment, and we actually made that happen. We actually dispoed that as well. The down payment, you typically want to get that as close to zero as possible. And I'm going to talk about trade-offs here after this. And then interest rate. When they say interest rate, is it 10%? Is it 5%? You have kind of the benchmark of what's the going rate. Like right now, say it's 7% is your going investor rate or 8%. So anything you get below that, it's a good deal from an interest rate standpoint. But you can also go above that interest rate. It doesn't have to be fixed. It doesn't have to be zero. However, if you can negotiate 0% interest, principal only, you can really trade off on some of these other inputs because that is just the ultimate maximized leverage, right? You're getting money for free. And then lastly, that monthly payment amortization. So you typically hear like when people go and get a 15-year loan or a 30-year loan, that's basically the amortization of that loan. That's how many years you have that loan is theoretically split up. If you took the loan out for 30 years, each payment would be split up evenly. And then by the end of that 30 years, it would be paid off. Even if you have a 5-year balloon payment, right? You're still amortizing over 30 years. In 5 years, you will have 25 years left on that loan with the exact same amount of even payments. That's what it means. So in this case, I'll use our example for the deal. The guy wanted a 10% down payment. We don't love it. He also wanted 5% interest. Don't love it, but it's better than what the 8% we'd have to go if we got traditional funding right now on a commercial loan. 10% down payment, the purchase price was $425,000. Kind of a big down payment, honestly, but the ARV, the value now is $525,000. So we got equity. That's one of our trade-offs. We did get some good equity. We have a lower interest rate. He has a somewhat bigger, I'd prefer like 5% or 0%, but 10% is not bad. We have some people that want larger ones. But then here was the kicker. When he said 5% interest rate, I immediately knew, okay, let's not negotiate that right now. That's not a bad one. Of course, we want less, but let's ask him what he wants for a monthly payment. And sometimes you can seed this a little bit and say, hey, you know that they're renting for, say, $1,500, you know market rent's $2,000, say. You can seed this by saying, hey, you're getting $1,500 now, but you got to pay taxes, you have to pay insurance, you have to pay all these fees and property management. What if you didn't have to do anything? You didn't have to pay the tax. You don't have to do any of that. You just collect a check. I get you $1,000 a month. Is that a good payment for you? And get you that 5% interest. That to them is a pitch. Now, they're getting their same interest. They're not collecting the same gross revenue, but they're probably going to collect it near what they typically get after they actually pay for everything, right? So you're kind of backing it off because you know you're going to have to pay for those as well anyways. So you're getting that lower payment and you're fixing it, right? And so if they say, yep, that's okay. Well, on a $425,000 loan, if we have 5% interest for us, even less than $42,000 down payment, so say a $380,000 loan, to get to $1,000 a month payment, we're going to have 100-something year amortization. But that doesn't matter, right? Because he also wants a balloon in 5 years. But that 100-year amortization or whatever it is, I don't actually have the number in front of me, gets us to that $1,000 payment. Now, in our situation, it was actually an $1,800 payment is what he wanted. That's what we negotiated. And our rents were, around $2,500 or $2,600 is what we think is gross rents. So it's a great, great property if somebody wanted to rent it or just as a primary residence. So with that being said, we ended up having to adjust the amortization or the monthly payment amount to meet what he needed. And this is where I want to talk about trade-offs. So don't get immediately turned off when they want a big down payment, because it's like, hey, okay, if I can give you that big down payment, which is not typical, can you give me an interest-free loan, basically? Or can we do a principal-only loan is how I like that, where we pay you monthly principal-only payments. Or hey, if that's the case, if you want a $100,000 down payment, can I give you $1,000 a month? Since you're getting a bunch of money up front, can I give you $1,000 up per month? And then start doing these trade-offs. So the trade-offs come because little money out of pocket is great, right? So if you could get a zero upfront down payment, but you had a higher interest rate, that's okay, right? Because potentially you could be cash flowing less, but your ROI is much higher. So you have less skin in the game and you're getting, say, $200 a month in net cash flow. Okay, that's great. But if you have a higher down payment, you certainly want more of a cash flow because you have some reasonable ROI. So if you think about it from an ROI standpoint, that makes sense. And then on the amortization and interest rate, don't just immediately say balk at a high interest rate, because you know you can adjust the amortization. You can even pay a higher price for the property given a low interest rate, or given a low monthly payment, or both. So say the property is worth $500,000, pay $500,000 for it retail, especially if they're going to give you a 0% interest loan and your monthly payment's going to be $1,000 and you can rent it for $2,000, because now you're getting a great spread and you're getting a huge debt pay down. So Mike and I have done deals where we will just do a debt pay down play. We have one that we do right now. We get $600 a month is our monthly payment. It's 0% interest. So basically $600 goes to the debt pay down. We paid retail for the property. And the balloon is such that by the time it's paid down, we will have enough equity we could refinance it and still not have to bring money to it, or we could sell it and scrape the equity right then and there. Pure debt pay down pay, our monthly cash flow on it after all said and done is like $100, $200. It's not a lot, but when you add it with that debt pay down, it's considerably high. So thinking about the trade-off within those inputs is key. And the key, I'll just summarize this, is listen before you pitch. What do they care about? If they don't even bring up interest rate, don't bring up interest rate. Start with monthly payment. If they're really worried about a down payment, start there and then figure out the trade-off is. If they're okay with a low down payment and a bit higher monthly payment, then go there. If they want a big down payment and a high monthly payment, or low monthly payment, go there. But listen, most importantly, to what they're saying. And I try to tell this to our sales team whenever I bring this up, is it's a nuanced conversation that's not black and white. And it's more imperative during these conversations that you listen. Once you realize that a cash offer is not going to work, listen to what they need, listen to what they want, listen to where you can help them out, because you can trade off and adjust the down payment, the interest rate, and the amortization. Now, I'll give you one more crazy trade-off. So we talked about balloon payoff. What if they want a full retail asking price for a property? And even in 5 years, you're probably not going to be able to pay down enough debt to have enough equity in the property to get you to a refinance rate where you can not have to bring money to the table and you can refinance this person out and have 25% equity in the property. What if you could extend that payoff to 7 years or 10 years, or to a time that gives you enough time, if you pay retail, to have the debt terms paid down enough to where you don't have to come to the table at refinance with cash as a rental property? That's just another trade-off where, okay, and it's a math equation, right? And so it's like, okay, you're de-risking yourself of holding on to debt and holding on to an asset that you can't do anything with at the time that the loan comes due. So trade that off. So push out the loan due date and increase the price. Sometimes, in some cases, you can even pay more than value if you look at your debt terms. So say the property's worth $500,000 and you're like, hey, Mr. Seller, your house is worth $500,000. What if I can give you $525,000? That's $25,000 over anybody's offer. But what I want you to do is I want you to carry the note for this property, and I'm going to give you X percent interest. You're going to get a good interest rate. You're going to get this. You're going to get that. But during that period of time, you need the debt pay down and you need some cash flow, because it is a defensive move. You don't want to just go all in on the debt. You want some cash flow out of that. But you can easily do that just by adjusting one thing, which is the balloon payment. And you can now increase the other terms. So it really becomes a trade-off. That's really all I want to talk about as far as negotiating. And then also think about your exit. I'll just shut up after this, so this one doesn't run too long. But your exit, you can pay attention to that. So on your exit, you can wholesale this to a buy and hold investor. You can wholesale this to a flipper potentially, depending on how much margin's in there and what the terms are. You can flip it yourself, buy and hold it yourself. Typically what I see is good exits are buy and hold or wholesaling to a buy and hold person. So that wholesale typically looks like an increased sale price and an increased down payment to match that. So if the seller wants a 10% down payment on a $100,000 house, the seller needs $10,000, right? Say you want to make $10,000 on this wholesale fee, then you need to increase the sales price to say $110,000 and then have essentially a 20%, but not quite 20% down payment. If that math goes right, then basically the loan is actually $100,000 or $90,000, basically, whatever the seller is expecting that loan to be, and the seller gets $10,000 for the down and you get $10,000 for the down. Fundamentally, that's what you're trying to do on those. Or, which is even more creative and a lot more fun, which is what we're going to do on ours, is do a seller wrap. So then wrap up that seller finance note and actually add in some monthly margin. So you can do that by increasing the interest rate. So say you negotiate a really low interest rate, you could give the seller or the new buyer all the same terms, except for instead of it being a 5% interest rate, sell to them on at 8%. And then you just collect that 3% interest margin right to you out of escrow, and you set up an escrow with a local escrow company. Or you can adjust the sales price of the property to a higher sales price, lower the amortization so the amount coming in every month is higher, paying that seller exactly what they're expected and paying that loan down for exactly what is expected for each month. But then you're collecting the rest into your pocket because now you've got, say, for example, the house is $100,000 and you sell it on a wrap to a new buyer for $125,000. So basically you're amortizing the $100,000 with your seller and all their terms, and then you're taking your $25,000 and amortizing it for yourself, and you're collecting that over a longer period of time in addition to any down payment you've collected. So that one gets a little confusing. So do some research, hit me up in the DMs, hit us up, and feel free to ask me questions on how to actually set that up with the paperwork and all that sort of stuff. But I'll stop there at the exit because I know we can get really complicated and detailed here on lots of other things. But fundamentally, with those exits, it's just like a straight wholesale, like I said, and you typically make up your fee on the down payment and an increased sales price or the wrap. Those are the two most popular and the two, honestly, best and most profitable ways to do these things. So I'll stop there. As I said, again, if you have questions, hit me up on Instagram at InvestorManDan. I love answering questions for people, especially about creative finance, because it's so much fun when, you talk about it a lot. It's like a really hard math problem, but then once it clicks, they can forever negotiate these deals and it's not an issue anymore. It's got to click. You got to hear it enough times. So without further ado, I will end it just the way I started it and send you guys to collectingkeys.com. Check out the Instant Investor program there. Book a call with us. Also, like and share these as much as possible. Post it on Instagram. Say whichever your favorite episode is. Give us a 5-star review. All that sort of stuff helps us grow so that we can have more cool things like KeysCon down in Scottsdale for all you guys out there wanting to show up and hang out with us. So, all right, I will let you all go. See y'all next week.
Thanks for listening to this Collecting Keys Friday Focus. Be sure to subscribe wherever you listen to your podcasts.